Good day to all. This is the third part of translation of foreign currency financial statements. And our focus will be, if we can recall, there was a type of hedging that wasn't discussed in accounting for foreign currency transactions. And this was about hedging in a net investment or foreign operation. So this is timely because we are discussing like translation of foreign currency financial statements, which is the financial statement or which are the financial statements and reports of foreign currency operations, whatever subsidiaries, whatever branches, or whatever associates that are in other countries or operating in foreign countries. Now, let us go to our source once more. This is just going to be a short discussion or video. If we can recall, for hedging, this is a risk management technique in order for us to minimize or mitigate the losses that there are in an organization as they're exposed to a lot of things. Could be fair value changes or fluctuations for cash flows or foreign currencies, for example. And in this one, for example, for foreign currencies involved in foreign entity operations. So that's actually what risks are there. So in order for such business as a whole to be protected from the fluctuations, it may hedge that net investment in a foreign entity. So take note also that hedging is optional, and this is not something that is really automatic if ever we see a foreign entity that there is already hedging. That's not the case. If you can recall, we also said that fair value hedge is going to reflect all changes in the hedged item and the hedging instrument to profit or loss. We just have also to take note that the hedged item here would be the foreign operations, and the hedging instrument will be, for example, the forward contract that is used in this particular case or whatever contracts such are. Then for cash flow hedge, remember we do not actually account for the changes on the hedged item, only the changes in the hedging instrument. All right, so that's what we are going to do here. Likewise, for hedging a net investment in a foreign entity, we are going to apply same concept as the cash flow hedge with respect to the reflection of changes in the hedging instrument. First, OCI section of statement of comprehensive income for the current changes, and for the cumulative in the statement of financial position one line, but the changes and all the details will be on the statement of changes in equity. Okay, so that's one thing that we should take note. Also, there is a special shareholders equity account, which is the cumulative translation adjustment, which is OCI, in which we've discussed that already in part one. So this will accumulate all exchange rate adjustments on transactions. Example, we have Pinoy Corporation, a Philippine company, has a 30% equity investment in a Hong Kong company, King Incorporated. And then this is for the year 2012 operations. The balance in Pinoy's investment in King account is 3,120,000, which is equivalent to 30%. So in this case, 30%, which is within 20% to 30%, we can say that King Incorporated is an associate of Pinoy Corporation, in which you are going to make use of equity method. So remember, in equity method, to compute the balance of the investment, that would be investment balance. We're going to add share in profits, deduct if losses, and deduct the share in the dividends from the foreign operation or from the associate. That's under IAS 28, by the way, investments in associates and joint ventures. Then that's coming from 2 million times 5.2. On this date, Pinoy has no translation adjustment balance relative to its investment in King. And then to hedge its net investment in King, Pinoy borrows 500,000 Hong Kong dollars for 1 year at 12% interest. So this is a loan, a debt instrument that is being used as hedge instrument or hedging instrument in order to protect the company for fluctuations for the foreign currency changes or differences that will involve the company in its operations. So this is how we are going to journalize the loan. This basic accounting, debit cash, credit loans payable at the spot rate at the date of transactions. Now, assumption is that on November 2, 2013, King declares and pays a 100,000 Hong Kong dollars dividend with the spot rate is 5.35. So if it is a dividend that is really declared, remember in part one, we really said that we are going to use or make use of the spot rate at the date of transaction. While for the net income, the profit or losses, we have to use the weighted average exchange rates for expediency or practical expediency purposes to make the job of translation easier and faster. And the closing exchange rate on December 31 is 5.4, which is what we are going to use for our net assets ending. I like this particular presentation better than what we've had in part one because it shows to us the net assets, then up to beginning and ending. Then we also have comprehensive income, profit or loss component, dividends paid, and the translation adjustment will be the balancing amount or figure. So this is a better presentation. Okay, these are now the changes so that we will get translation adjustment of 435,000 because we did not have any balance from prior years. That's why this would be the ending balance of translation adjustment. Okay, record the transactions now for Pinoy. We have the dividends. For cost method for business combinations, remember we are going to credit this with dividend income. But then for equity method, we are going to credit the investment account for such to be deducted at 30% at the rate at the date of declaration, 5.35. Then another one is for the share in the comprehensive income items. So we have addition because the income from subsidiary is of course profit, right? That's profit from here. 400,000 times 5.30 equals this amount times 30%, that's 636,000. While the translation adjustment is credit balance, so it's going to be also on the credit. That's the share of the company, the Filipino, or what was that? Pinoy Corporation, a Philippine company. And then from the associate, which is King Company, okay, or King Incorporated. All right, so forgive me for moving up and down just to emphasize the point and letting you see certain parts there. All right, and another one is this part here, translation adjustment, OCI, and the loans payable. So in this case, we have to adjust the loans payable to be equal to the closing rate. Let's check the closing rate. That's closing rate as given in the problem is here, 5.4. And it was recorded at 5.2 at spot rate. Therefore, there's a need for us to translate that into the current or closing rate so that it will become 100,000 more or much more. And then translation adjustment will be debited. Then we also have to include our computations for accrued interest payable, which is good for 1 year at 12%. Then that's 5.4 closing because that's a liability. But for the expense, which is using 5.3, 5.3 is the average rate for expenses so that there would be a forex loss because we are actually having more liability than what we expensed. All right, so that's for 2013. Now for continuation, well, anyway, before we proceed, so we can notice that there is really a difference between hedging and a net investment operation with transactions that are anticipated under the previous chapter in that we actually did not record anything involving the hedged item. But here, that's why this is really a separate from the cash flow hedge, because we are going to record transactions involving the hedged item, which is the foreign currency operation or the foreign operation. You can notice that based on these entries though, for the profits, shares, losses, dividends, even the translation adjustment or OCI item. Then for 2014, the moment that the loan is paid, of course, it will be at the rate in which this was the spot rate. So 2,700,000. Let's check, because this was 2,600,000 before plus 100,000 equals to 7. Accrued interest payable is from here and we pay cash. As a result of the hedging, the changes in Pinoy's investment in King were partially offset by its loan in Hong Kong dollars. So the translation adjustment OCI that will appear in the shareholders or stockholders equity section of the balance sheet of Pinoy will be the net amount or value. 130,000 is with 500 credit, and this is debit, so that it will be 30,500 balance, right? So that's the end of part 3. Thank you very much for listening, and God bless us all.